The Nigerian Stock Exchange has witnessed a roller coaster ride in the first half of 2024, with the banking sector experiencing a notable decline of 7.47% in the NGX Banking Index. However, this week has seen a resurgence of positive sentiments towards the sector. Is there a connection between this shift and the ongoing bank recapitalization exercise mandated by the CBN? As the Securities and Exchange Commission unveils guidelines for banks to raise capital in the capital market, we'll delve into this recapitalization effort, examining its impact on key players and the overall market response. We'll also talk about the potential for upcoming mergers and acquisitions in light of the recapitalization requirements. Joining me for this is Nabila Mohammed, Banking Sector Analyst at Chapel Hill Denham. Thank you, Nabila, for joining me today. Maybe you need to unmute.
Good morning. Thank you for having me. Can you hear me?
Yes, I can hear you now. Well, the NGX Banking Index declined by 7.47% to emerge as the worst performing index on the local bourse in first half 2024. However, this week looks somehow favorable for the sector. Are the days of continuous decline in that sector over, or what is spurring this present sentiment? Maybe I'd like to have your thoughts on both, the half-year result and the sentiment we're seeing now.
So if we split the first half of the year into two quarters, that's Q1 24 versus Q2 24, what we noticed was that Q1 24 performance for the banking index was positive, and I would like to liken that to look at it from the perspective of the fact that it was a spillover of the continued interest in the banking names given their performance in 2023. However, Q2 saw a pullback in the performance of the index, largely as a result of the announcement of the recapitalization by the CBN that ended Q1. When that happened, we started to see some form of exits and profit-taking activities in the name. And as at that time, there was not much clarity around the banks and how they intend to raise their capital, given that they were also given a month within the first month of the second quarter to submit their plans to CBN. So all that sort of caused some form of ambiguity in the capital raising process, and we started to see panic selling. We started to see people take profits, given the rally that happened in Q1. Now, as you rightly said, we are starting to see renewed interest in these names, and it's largely because we now know some of the bank's plans with regards to how they intend to raise capital, and that provides some form of comfort to investors that okay, this is what this particular bank plans to do and how they intend to go about it. So it is reversing that pullback that we are seeing, that we saw in the second quarter of the year, and it's likely to continue, coupled with the fact that we would expect them to announce their H1 results. We also expect interim dividend announcement that would also spur investors' sentiment in the banking names.
That's interesting. Now, I don't know what you see, but of course, SEC said that its guideline is to ensure a smooth, transparent, and efficient capital raising process in the capital market. But what some industry players see is SEC planned sanctions for issuing houses. Let me get your thoughts on this.
So, as my simple thought on this is that the regulator is practically just doing its job. They are known to provide clarity with regards to how all their capital market operators are meant to play or act in any and every transaction that they take part in. So it is not unsurprising that they will come up with that, given that the bank recapitalization exercise is quite topical.
But you know what, Nabila, some persons are saying what is very loud in that particular guideline is actually the penalty, the 1 million naira and the 100,000 naira. That's what they are saying. That why are you all about just, turning everything into a money-making venture?
We all know that it is not surprising to see a regulator provide rules and regulations to be abided by, and failure to do so will result in sanctions. It's a normal phenomenon across different regulators and how they intend to play based on who they are regulating. So they did provide clarity, they did provide the requirements based on whatever transaction process that is going to be played out by the banks or the other capital market operators. But then they also have to put some form of sanction that if you do not follow this rule, then this will be the penalty for it. And I feel, in my opinion, my simple thought is it it is not surprising, it is normal and expected of every regulator with regards to how they want their rules to be followed.
All right, away from SEC now, as an industry watcher, which you are, tell us how the process has been so far. I mean, Fidelity Bank is leading the pack already. Access Holdings has talked about what it's doing. GTCO also, we should be expecting GTCO to also tell us, facts behind the offer and all of those things. Now, tell us, where are we right now?
So, like you rightly said, and like I earlier mentioned as well, we have seen more banks come out to announce how their capital raising plans. Total so far, we have about 7 banks that have disclosed how much they will be raising in the capital markets, which is almost like a 1.7 trillion. And this is where we are right now. Fidelity is currently in the market with their public offer / rights issue. We have Access that is likely to open next week as well because they did the signing ceremony this week. We also are aware of GTCO that plans to open its offer in July. That's this month they're currently in. And we should see more banks also unfold their plans. So all this, as I earlier mentioned, has sort of calmed down the market because there's now a way forward, a clarity around how these banks are, what these banks are planning to raise and how they intend to raise it. So we'll definitely see more unfold, especially for those that are yet to disclose how much they are, not how much, rather how they intend to raise the monies that they have disclosed they would raise.
Okay, so I mean, a lot of the information we have right now sort of boils down to the capital markets, whether it's rights issue or public offer or private placements and all of those. Is it too early to expect some M&As or some, step down in the license authorization?
Well, in my view, it is too early to tell because number one, they have given them as long as 2026 to meet the new capital requirements, and as we know, not all of them have fully disclosed how their plans about the whole recapitalization exercise will pan out. So definitely, will not rule that out, but I feel it's too early, given that the market is currently very active and these banks are looking to really utilize the active markets to raise money. So once we start to see how well they do with regards to their capital raising, then we'll definitely know whether we'll see an M&A going down the line. However, I do not really expect anyone to downgrade license. I feel like that would be the last resort for any bank that feels they are unable to meet up with the new capital requirements. And for any bank that is trying to look at grow in the near future, downgrading the license will not be a go-to option for that type of bank.
Well, let's get to the part that sort of concerns shareholders, people who are thinking if they should be a part of this activity or not. Access hopes to offer 17.773 billion ordinary shares of 50 kobo each at 19 naira 75 kobo per share. That's based on, one new ordinary share for every 2 existing ordinary shares held as of June 7, 2024. Now, put that beside Fidelity Bank's 1 new ordinary share for every 10 ordinary shares held as of 5th January 2024 at 9 naira 25 kobo per share. If you were to advise, investors, what would you say?
So I'll start by saying that both banks are very fundamentally sound in their respective rights. Access Bank boasts of the largest bank in terms of total assets, in terms of customer base, and it has its footprint as well across Africa and beyond Africa. We have Fidelity in the tier 2 space, having the highest return on average equity when you look at tier 2 peers. So one thing I would want investors to really look at is that the scale at which the amount that these 2 banks are planning to raise differ. The number of shares that they intend to add differ. I'm talking about 127.1 billion for Fidelity, both in the combined offer, that's a rights issue and public offer, and 351 billion for Access Bank, would seek to increase their shares outstanding by 17 billion versus 13.2 billion. So the scale at which these 2 banks are planning to raise capital differs. So we would not expect that the ratio or the sharing ratio would be same for both of them. And what I would advise investors is that these 2 banks are fundamentally sound. So the advice really is for them to take up their rights and participate actively when now that Fidelity is open and Access is about to open. Just take part fully in the whole exercise. And just this week again, one thing we saw Fidelity announce was that they will be having another EGM where they will be seeking to increase, add additional shares of around 8.2 billion ordinary shares. And this is in anticipation of the fact that they expect to see an oversubscription based on the rate at which their current combined offer is running. So all these things are positive news, and as I said, they are fundamentally sound financial institutions, and investors really should just take up their rights when they have the opportunity to do so.
Talking about Fidelity Bank, I remember Tuesday, was it Tuesday? Yeah, Wednesday, it was over 100 million shares, that were traded. And yesterday, over 500 million shares were traded. What does that tell us about, how investors are responding to it?
The response to the capital raised by Fidelity is very positive. And as you rightly said, we are seeing traction, we are seeing improved activities. And this is not just based on, following the crowd or trying to do what everyone else is doing. They also understand that investors are now in the picture of this bank is fundamentally sound, and this is their performance trajectory in the past, and this is how they intend to move going forward. So all these things are positive, and this is what is resulting in the improved participation in the combined offer that has been opened in the market.
Well, as more banks come to the market for capital, what impact do you think this will have on the market? Because, beg your pardon, some of us are already seeing, dilution and all of that. Should we be worried? Should we be scared, or just play along and see how everything unfolds eventually?
So the dilutive impact of the capital raise is there. It will be there, especially in the first year of capital raise. But then beyond that, when they start to really deploy the capital that they have raised, that these banks have raised, into growing the real sector of the economy, and it translates to higher returns for the bank, then we'll definitely see that dilutive impact wanes off. So it is for the short term, and I'd advise that investors stay the term while this dilutive impact wanes out. It's only going to be, especially in the first year of the capital raise, and beyond that, we will definitely see them return back to strong earnings that we see them post, given how fundamentally sound they are.
I want us to stay a bit on this. Talk to us about the risks and benefits of additional equity capital injection for shareholders.
So I would like us to look at it from 2 points of view. Right now, they are at the stage where cash flows would increase for them, for the banks, given that they are raising money. So beyond the cash flow that will be raised, the risk will now be that you've raised this amount of money. How do you intend to deploy it? What would you be considering when you are trying to create risk assets and trying to ultimately grow the economy by providing financing to the real sector? So that is where we would expect banks to be highly prudent in terms of lending, in order to make sure that whatever monies that they have raised via the capital raising exercise is deployed prudently to sectors that will be improved at the end of the day. So it is one thing to raise money, but it's also another thing to create value. So we would have to move from the cash flow stage to value creation stage.
All right. Well, talking about that, we're looking at the various options available. And just like you said earlier, we shouldn't be talking or looking at M&A for now and all of those. But do you think that Fidelity Bank, or let me put it in another way, let me reframe this particular question. Are you concerned about, Fidelity Bank being able to raise that amount to maintain its authorization?
So, like I earlier said, they did disclose this week, I think on the 3rd of July, as on Wednesday, that they would be seeking to raise an additional, to increase their shares outstanding by an additional 8.2 billion ordinary shares. And they did mention in the disclosure that it is in anticipation of an oversubscription of the current offer that is in the market. And like you earlier mentioned, this week it has been amongst the top traded stocks, and it's largely because of what is happening in the name. And in my view, I am not concerned, because right now the market is active. and there are a lot of players. There is improved participation. If we even look at how the participation in the equities market has improved over the years, investors are now enlightened, they are more knowledgeable, they understand the market more in this day and age. So it will not, I do not see that they will not be able to meet up with the capital
500
raise
billion
that they are
naira.
currently in the market on for. So based on the fact that they have even come out to say they are going to increase their shares and also offer more beyond the July 29th, that is the deadline or the close date for the current offer in the market, is a positive sign that they are very positive that they will definitely meet the amount they intend to raise. And that will now translate to an additional 78 billion naira. If we add that to the 127.1 and add it as well to the 129 billion they currently have as their core capital or capital that is needed to really qualify, we would definitely will see them reduce the amount left for them to raise to around 165 billion. So if they continue at this pace, definitely they will be able to meet up with their the requirement based on their authorization, which is an international license. And
Right.
besides,
Nabi,
I would like to add again that they just recently acquired an international subsidiary. So someone that a bank that just recently did that will not be willing to let go of an authorization that they just solidified with an acquisition.
all right, I would like to just put this, and that's the fact that I think coming to the market earlier than any other bank sort of worked for Fidelity and is still working for Fidelity. I guess you share the same sentiment.
Yeah, definitely.